Hello and welcome to this presentation on the paper by Kenneth French and James Porter-Burr in 1991 on investors' diversification and international equity markets. So this paper looks into the potential reasons why investors hold nearly all their wealth in domestic assets, and they focus on the USA, Japan and British investors and understanding potential reasons for domestic bias in 1989 and in previous history. It uses a simple model of investor preferences, utility theory, like we've learned in our own content, looking at the risk aversion utility function to understand and predict investors' behaviour, all with the underpinning theory of the prospect theory developed by Tversky and Kahneman. And this is used as the main model to try and understand for the domestic bias for equity market and why they tend to not diversify their portfolios into foreign markets. And then it also looks into trying to understand why there is lack of diversification and therefore sort of incomplete diversification, and therefore maybe a lack of hiding that idiosyncratic risk, and the reasons why that is a choice rather than a constraint for the investor. So we look at international ownership, and looking at what they found in this paper, you can see that this is showing the weight of the portfolios of a UK investor, Japanese investor and US investor. As you can see, there is some domestic biases. Obviously, a majority of that portfolio weight is weighted towards their own domestic country in the UK, and we can see that with Japan and also in the USA. So obviously there's no hiding here that there is some domestic bias. However, we can see that it was starting to grow in the early 90s, later 90s. As we can see that in over years, we see that the UK pension funds held 21% of their assets in foreign equities in 1990, and this increased from 6% in 1979. And then if we fast forward today, if we look at the Pension Policy Institute, they estimate that about 70% of the pension funds are allocated into overseas stocks. So we can see, and as we go on this presentation, we'll look at comparison into how this paper holds today and potential reasons why this has increased so much in modern day. So now we go into the really crux of the paper, where it discusses the model of how it will analyze this domestic bias and reasons for it. So the model assumes that the investor takes a forward contract. So this is basically an agreement with a party to say we will pay for X amount at a price X in 3 months' time. This is a great way to hedge exchange rate risk. For example, let's say you're a British investor wanting to buy US stocks. So you need to pay using pounds, exchange it to US dollars to buy the stock. Now let's say the pound depreciates by 20%. So now you have to increase the amount of payment by 20% to get the same amount of US stock. And therefore, let's say the stock was to increase by 20%, that means you would actually gain nothing from it. So by doing this, you are able to, I guess, have a better prediction and also hedge that risk of depreciation. On the other hand, you could lose out in this if let's say the pound was depreciate. That means now it's cheaper to buy those US stocks. However, assuming a risk-averse investor, they are more likely to hedge that negative impact rather than take the risk that it might appreciate. It then looks at pairwise correlation between the stocks, and it looks at a date time frame between 1975 and 1989, and this equates to 0.502, which is perfect as it allows for some risk reduction to be available. Now, let's say this was 1, then let's say you've got a portfolio of 2 stocks, so one stock decreases because they're perfectly correlated, the other one will decrease. Therefore, there's no sort of risk reduction as though it just both make losses. Now, let's say if the correlation was 0, as we learned, that means there's some perfect risk reduction, because as one stock reduces, the other one would increase, and therefore they cancel each other out, and there's no risk involved for the investor. And this model also assumes that the risk-averse investor assumes that there is a risk-averse investor. Is it a fair assumption, as understood by prospect theory, as people feel losses more than their wins? And also in many theoretical models, such as the capital sort of the Markowitz problem, which is really the powerhouse of the capital asset pricing model, they also use a risk-averse investor where their mean return, mean optimizers, and variance minimizers. And to capture this risk-averse investor, like we've learned, they've used a risk-averse utility model. They've used constant relative risk aversion, whereas I believe we learnt relative risk aversion utility model, which is slightly similar, but however this capture slightly simpler, but this captures in essence a similar thing, where lambda equates to the coefficient of constant absolute risk aversion, where I believe in our learnings that was A. The W, it denotes the weight associated with the average return. So let's say 0.5% of this stock of the portfolio will be, and this is how much return we're going to get from that. And then U is the average rate of return. And then also we've got sigma, which is the covariance. And then this equation here is the average rate of return. So you've got the coefficient risk, the weight, and obviously the covariance matrix. And it also assumes that investors equally weight the stocks within the portfolio. So that means W would be, in this case, 1/6. So now looking at the results using this model. So what it shows here is that the UK would need 5.2% returns higher than the US to even think about investing in a US stock. This potential reasons for this is that the UK returns are much higher due to maybe more, this would imply that there would be higher risk. Therefore, investors require a higher risk premium. And obviously, if we look here, the risk premium simple calculation is the market return minus the risk-free rate, and the risk-free is normally calculated as the treasury bills, and obviously that in theory they're seen as risk-free, especially if it's a AAA rated treasury such as the US Treasury. Then there's very little chance of default on these treasury bills. Also, as this paper is looking at the domestic biases, some early understandings how why there might be some domestic bias. As you can see, that if you look at UK investors, they expect expected returns to justify the observed portfolio rates as highest for UK returns. If you look at Japan, the highest for Japan, and US, highest for the US as well. So you could see that there might be some extra optimism within the markets because of familiarity, and as we've discussed, potential reasons why this might be the case, why the expected returns need to justify that observed portfolio rates is higher for their own markets. So they then look at a different way to try and understand why there might be some domestic bias. And if we focus on panel B, we can see that this implies that investors expect their domestic returns to be higher than the diversified portfolios abroad. And as you can see, that if you look at the US, that they are very optimistic, most optimistic about their own markets, and with everyone else, they're very pessimistic. And then Canada, very close by, nearby, and as we can see, and as I'll explain in the next slide, the proximity to the market, or I guess location, geographical location, has a positive impact upon foreign bias in portfolio diversification. And as you can see this in Japan as well, most optimistic about their own market. Same here in the UK, again 4.4. So there might be, so you can say that the domestic investors are more optimistic, are very highly optimistic of their own markets, and potential reasons for this is that there could be information gaps between other countries. There could be language barriers, or issues with technology, problems with technology advancements in 1990. Probably less of a problem now, and we'll come to that later on to see how the picture has changed in that foreign versus domestic bias. We have foreign tax burdens, and as Kenneth French discusses, this has got very little impact as a tax between countries on equity assets. Is very little differences back in 1989. Transaction costs, very limited impact because there's very small transaction costs involved across countries, and limits on cross-border investments. Again, this is another reason that might be quite a weak argument, because, for example, France. In France, you may not hold more than 20% of any fund without authorization. However, a majority of investors are probably not looking to hold more than 20% of any firm. These would be big institutions holding these, and again, another weak argument for reasons for this domestic bias. However, if we look at what other papers have found and understood, we can see maybe potential reason for this domestic bias and reasons that drive it, or drive foreign bias. So if you look at Chan K, they discovered how mutual fund allocation of domestic bias is determined by stock market development and familiarity. So obviously, if the stock market is doing really well in their domestic market, they're going to obviously invest in domestic stocks compared to, let's say, maybe a worse performing foreign market. And also familiarity, as I discussed before. This is very crucial in terms of understanding language barriers, especially if it's let's say they're doing credit default swaps, and that's two parties coming together to come to a best agreement. So obviously language barriers will be a big part in that, and also, like, I guess, the understanding of the market. There might be some information gaps in that. He also found that remoteness and language barriers, as I said, language barriers results in higher domestic investment. So obviously, if they're more remote, then obviously familiarity to their own market will be much higher than to obviously foreign markets. And as I said, I've already argued the language barrier. Also, Chan K et al. In 2005 found that the capital controls have limited impact on any bias. As we said, that argument that you need authorization to have more than 20% of a company's control of 20% control of a company is a very weak argument, and Chan K backed this up. If we look at Pagano, Rael, and Zachner, they also found that familiarity and location proximity, and location proximity is actually quite interesting here, because you can see that US investors were quite optimistic about Canada, obviously bordering country, which would back that up to be influential in domestic bias and foreign bias, for example. And again, going back to the terms of language, helps reduce asymmetric information. Obviously, understand the market, the information available to you. And then Ambaltzer et al. In 2013, again, found proximity to other countries where they invest reduces foreign bias. So yeah, they're more likely to invest in those foreign stocks and assets. Then J. Dreisen in 2000 et al. In 2003 analysed how international portfolio diversification are largest for countries with high risk. So this sort of goes against some of the findings of Kenneth French et al. Because in 1989 you could see that UK returns were the expected returns were relatively high, which would indicate that investors require a higher risk premium because of the higher risk. Market risk, obviously, always market risk, because if you look at the capital asset pricing model, only market risk should be compensated by a risk premium, not the actual risk, idiosyncratic risk of the stock, because that can be diversified by the investor. So going back to my point, if we look back at that, the UK was where the expected returns were high back then because of the high risk. So it wouldn't make sense why there was quite a high amount of domestic bias if the investors would have known of the benefits of international diversification. However, Kenneth French may have an argument to understand this point, because they describe the difficulties in estimating ex-ante returns. Therefore, investors, because of the difficulties, just go along with their own investment rules and just deal with the losses because it's known to them. Again, that's the familiarity point. I come back to familiarity point. So now, looking and comparing what Kenneth French et al. Found back in 1991 to compare it to today. So, as I've pointed out previously, that Pension Policy Institute estimates that 70% of equity holdings are held in overseas equities. And one of the potential reasons for this is very simple to see, is that if we compare the FTSE all shares index, or the UK listed stocks, and then look at the world index of I believe this is the top 23 nations in the stocks, we can see that the world's foreign assets have actually to the UK have actually been outperforming from Q4 of 2017 to now. And as you can see, once we left the EU, this is shot up, and obviously reasons for this: handling of COVID compared to other countries, the Brexit issues we're having with supply chain issues, lack of HGV drivers are all driving this. And it'd be really interesting to see whether this divide gets bigger before it improves, and hopefully it does improve. And then also, if we also look at how the results hold up in the USA, because we can see in the UK that it looks totally different to what the findings of Kenneth French found, with actually foreign bias, with domestic bias not being existent anymore by the looks of it, considering that more than two thirds are being invested in foreign assets. So now if we look at USA, we can see that there's been a 175% increase from 2000 to 2018 in holdings of corporate foreign bonds by private pension funds. Obviously, this statistic, there may be some bias due to some population growth and obviously the aging population, but it does show a stark difference in the a massive increase of investors actually going to foreign assets. So far we've analysed the Kenneth French on investor bias, looked at some comparisons to what we've learnt, and applied some of the risk premium, the utility theory used to analyse, very similar to what we've learnt, and also compared it to how the findings they found back in 1999 to today, and we can see that it's sort of reversed. That now there's more of a foreign bias, and it'd be interesting to see that grow, especially in the UK with Brexit, and see how that impacts on the foreign bias that we're currently seeing. So thank you for listening, and here are my references.